When it comes to building wealth in the stock market, two major strategies often come up: value investing and growth investing. Each approach has its own philosophy, methods, and potential rewards. In this video, we'll break down what makes value and growth investing unique, explore their key differences, and help you understand which style might suit your financial goals best. Whether you're a beginner or a seasoned investor, understanding these two strategies is crucial for making informed decisions. Let's start by defining what value and growth investing actually mean and why they matter in today's market. Value investing is a strategy where investors look for stocks that appear to be undervalued by the market. This means buying shares of companies whose prices are lower than their intrinsic value, often determined by analyzing financial statements and fundamentals. Value investors believe that the market sometimes overreacts to bad news, causing stock prices to fall more than they should. By identifying these opportunities, value investors aim to buy low and hold until the market recognizes the company's true worth. This approach requires patience and a keen eye for financial details. Growth investing, on the other hand, focuses on companies that are expected to grow at an above-average rate compared to others in the market. Growth investors seek out businesses with strong potential for expansion, innovation, or market dominance. These companies often reinvest their earnings to fuel further growth, rather than paying dividends. Growth stocks can be more volatile, but they offer the possibility of significant returns if the company's growth story plays out as expected. This strategy is popular among those willing to take on more risk for higher potential rewards. Main difference between value and growth investing lies in what investors prioritize. Value investors look for bargains, stocks trading below their intrinsic value. Growth investors, meanwhile, are willing to pay a premium for companies with strong future prospects. Value stocks tend to be established companies with steady earnings, while growth stocks are often newer firms in rapidly expanding industries. Understanding these distinctions can help you decide which approach aligns with your investment goals and risk appetite. Some of the world's most successful investors have made their fortunes through value investing. Warren Buffett, often called the Oracle of Omaha, is perhaps the most famous example. He looks for companies with strong fundamentals, reliable earnings, and a margin of safety in their stock price. Other notable value investors include Benjamin Graham, the father of value investing, and Seth Klarman. Their disciplined approach has inspired countless others to seek out undervalued opportunities in the market. Growth investing has its own legends. Peter Lynch, who managed the Fidelity Magellan Fund, is renowned for his ability to spot high-growth companies early. Cathie Wood, founder of ARK Invest, is another prominent growth investor, focusing on disruptive innovation and technology. These investors are known for their willingness to embrace risk and their belief in the transformative power of growth companies. Their successes have made growth investing a popular strategy, especially among younger investors. Value investors use various metrics to identify undervalued stocks. Common indicators include low price to earnings, PE ratios, low price to book, PB ratios, and strong dividend yields. They analyze financial statements, looking for companies with solid balance sheets, consistent cash flow, and a history of profitability. By focusing on these factors, value investors aim to minimize risk and maximize long-term return. This analytical approach requires patience and a willingness to dig deep into company fundamentals. Growth investors look for companies with rapidly increasing revenues, expanding profit margins, and innovative products or services. They pay close attention to earnings growth rates, market trends, and the company's competitive position. Unlike value investors, growth investors may not be as concerned with traditional valuation metrics. Instead, they focus on the potential for future expansion and the company's ability to disrupt its industry. This forward-looking mindset is key to successful growth investing. Value and growth investing come with different risk profiles. Value stocks are often seen as less risky because they are typically established companies with stable earnings. However, they can remain undervalued for long periods, testing investors' patience. Growth stocks, while offering higher potential returns, are more volatile and sensitive to market sentiment. Rapid changes in technology or consumer preferences can impact their performance. Understanding your own risk tolerance is essential when choosing between these strategies. Value stocks are often found in sectors like finance, utilities, energy, and consumer staples. These industries tend to have mature companies with predictable earnings and steady cash flow. Because they are less likely to experience rapid growth, their stock prices can sometimes lag behind the broader market. However, their stability and reliable dividends make them attractive to conservative investors seeking steady returns over time. Growth stocks are commonly found in technology, healthcare, and consumer discretionary sectors. These industries are characterized by rapid innovation, evolving consumer preferences, and significant expansion opportunities. Companies in these sectors often reinvest profits to fuel further growth, rather than paying out dividends. As a result, their stock prices can rise quickly, but they also carry higher risk if growth expectations aren't met. One key difference between value and growth stocks is how they handle dividends. Value stocks often pay regular dividends, providing investors with a steady income stream. This is because these companies are usually more mature and have less need to reinvest profits. Growth stocks, on the other hand, typically reinvest earnings to support expansion, so they may not pay dividends at all. This distinction can influence which strategy is better suited to your financial need. Performance of value and growth stocks can vary depending on the market cycle. Value stocks often outperform during periods of economic recovery or when interest rates are rising. Growth stocks tend to shine during bull markets, when investors are optimistic and willing to pay a premium for future potential. Understanding how these strategies perform in different environments can help you make more informed investment decisions. For the long term, both value and growth investing have delivered strong returns, but their performance can fluctuate. Historically, value stocks have outperformed growth stocks during certain periods, especially after market downturns. However, in recent years, growth stocks, particularly in technology, have led the market. This ebb and flow highlights the importance of understanding market trends and being flexible with your investment approach. Value investors often need patience and discipline. It can be challenging to buy stocks that others are avoiding, and it may take time for the market to recognize a company's true value. This approach requires a contrarian mindset and the ability to withstand periods of underperformance. Value investors are typically comfortable with waiting for their thesis to play out, trusting in their analysis and the company's fundamentals. Growth investors are often optimistic and forward-looking. They believe in the potential of innovation and are willing to take on more risk for the chance of higher returns. This mindset can lead to big wins, but it also requires the ability to handle volatility and setbacks. Growth investors must be comfortable with uncertainty and confident in their ability to identify the next big opportunity. Both value and growth investors rely on financial analysis, but they focus on different metrics. Value investors dig into balance sheets, income statements, and cash flow to find undervalued companies. Growth investors, meanwhile, look for signs of rapid revenue and earnings growth, as well as market share expansion. Mastering financial analysis is essential for success in either strategy, as it helps investors make informed decisions based on data. Interest rates can have a significant impact on both value and growth stocks. When rates rise, value stocks often perform better because their stable earnings become more attractive. Growth stocks, which rely on future profits, can be hurt by higher rates, as borrowing costs increase and future earnings are discounted more heavily. Understanding this relationship can help you anticipate how different stocks might react to changes in the economic environment. Dividends play a different role in value and growth investing. For value investors, dividends provide a steady income stream and can help cushion returns during market downturns. Growth investors, however, are more focused on capital appreciation and may not prioritize dividends. Deciding how important dividends are to your investment strategy can help you choose between value and growth stocks. Many investors choose to diversify their portfolios by including both value and growth stocks. This approach can help balance risk and reward, as the two strategies often perform differently depending on market conditions. Diversification can smooth out returns over time and reduce the impact of any single stock or sector underperforming. It's a practical way to benefit from the strengths of both investing styles. Investors can access value and growth strategies through exchange-traded funds, ETFs, and mutual funds. These investment vehicles offer exposure to a basket of stocks that fit a particular style, making it easier to implement your chosen strategy. Many funds are specifically designed to track value or growth indexes, allowing investors to benefit from professional management and diversification. Value investors rely on several key metrics to identify opportunities. These include the price-to-earnings, PE ratio, price-to-book, PB ratio, and dividend yield. A low PE or PB ratio can indicate that a stock is undervalued relative to its peers. Dividend yield shows how much income you can expect from dividends relative to the stock price. Mastering these metrics is essential for successful value investing. Growth investors focus on metrics that highlight a company's expansion potential. Revenue growth rate, earnings per share, EPS growth, and return on equity ROE are commonly used. High revenue and EPS growth rates suggest a company is expanding quickly, while strong ROE indicates efficient use of capital. These metrics help growth investors spot companies with the potential to outperform the market. Value trap occurs when a stock appears cheap based on traditional metrics, but is actually declining for fundamental reasons. These companies may face structural challenges, declining industries, or management issues that prevent recovery. Value investors must be cautious and look beyond the numbers to avoid falling into value traps. Thorough research and skepticism are essential to avoid costly mistakes. Growth bubbles happen when investors become overly optimistic about a company's future, driving its stock price far above its intrinsic value. This can lead to sharp corrections if growth expectations aren't met. Growth investors need to be wary of hype and ensure that a company's fundamentals support its valuation. Avoiding bubbles requires discipline and a realistic assessment of future prospects. Economic conditions can influence the performance of value and growth stocks. During periods of economic uncertainty or recession, value stocks may hold up better due to their stable earnings and dividends. In contrast, growth stocks often perform best when the economy is expanding and consumer confidence is high. Keeping an eye on economic trends can help you adjust your investment strategy accordingly. Inflation affects value and growth stocks differently. Value stocks, with their steady earnings and dividends, can provide a hedge against rising prices. Growth stocks, however, may struggle if inflation leads to higher interest rates and borrowing costs. Understanding how inflation impacts different types of stocks can help you make more resilient investment choices. Value and growth investing aren't limited to any one country. Investors can apply these strategies in global markets, seeking opportunities in both developed and emerging economies. Different regions may favor one style over the other depending on their economic stage and industry composition. Diversifying internationally can open up new possibilities and help manage risk. Both value and growth investors are susceptible to behavioral biases. Value investors may hold onto losing stocks too long, hoping for a turnaround. Growth investors can get caught up in hype and overpay for popular companies. Being aware of these biases and maintaining a disciplined approach is crucial for long-term success in any investing style. Taxes can impact the returns of both value and growth investments. Value stocks that pay dividends may generate regular taxable income, while growth stocks may result in capital gains when sold. Understanding the tax implications of each strategy can help you optimize your after-tax returns and plan your investment approach more effectively. Value investing is generally associated with a long-term perspective, as it can take time for undervalued stocks to realize their potential. Growth investing can also be long-term, but some investors may seek quicker gains from rapidly rising stocks. Understanding your own time horizon is important when choosing an investment strategy that matches your goals. Technology has made it easier than ever to research and invest in value and growth stocks. Online platforms provide access to financial data, analysis tools, and trading capabilities. Investors can now compare stocks, track performance, and execute trades with just a few clicks. Embracing technology can help you stay informed and make smarter investment decisions. Both value and growth investors can make mistakes such as ignoring fundamentals, chasing hype, or failing to diversify. It's important to stick to your investment plan, do thorough research, and avoid emotional decisions. Learning from past errors and staying disciplined can help you achieve better results over time. Some investors choose to blend value and growth strategies, seeking the best of both worlds. This approach can provide balance, capturing opportunities in undervalued stocks while also benefiting from high-growth companies. Blending styles requires careful selection and ongoing monitoring, but it can help smooth out returns and reduce risk. Let's look at a classic value stock example. Imagine a well-established utility company with a long history of steady earnings and regular dividends. Its stock price has fallen due to temporary market concerns, but its fundamentals remain strong. A value investor might see this as an opportunity to buy at a discount, expecting the price to recover as the market recognizes the company's true worth. Now consider a technology startup that's rapidly expanding its market share with innovative products. The company reinvests all its profits to fuel further growth and doesn't pay dividends. Its stock price is high relative to current earnings, but investors believe in its future potential. A growth investor might buy shares, hoping to benefit from the company's continued expansion and rising stock price. Choosing between value and growth investing starts with understanding your own financial goals. Are you seeking steady income, long-term appreciation, or a mix of both? Your time horizon, risk tolerance, and income needs should guide your decision. Taking the time to clarify your objectives will help you select the strategy that best fits your unique situation. Markets are always evolving, and successful investors adapt their strategies accordingly. Sometimes value stocks lead, while at other times growth stocks outperform. Staying flexible and open to change can help you navigate shifting market conditions and take advantage of new opportunities as they arise. Studying the strategies of legendary investors can provide valuable insights. Whether you admire Warren Buffett's value approach or Peter Lynch's growth philosophy, learning from their successes and mistakes can help you refine your own investment style. Reading books, interviews, and annual letters can deepen your understanding and inspire your journey. Patience is a virtue in both value and growth investing. Markets can be unpredictable, and it often takes time for your investment thesis to play out. Staying patient and sticking to your plan, even during periods of volatility, can increase your chances of long-term success. Remember, investing is a marathon, not a sprint. The world of investing is always changing, and ongoing education is key to staying ahead. Reading books, following market news, and learning from experienced investors can help you refine your approach. Whether you choose value, growth, or a blend of both, staying informed will help you make better decisions and adapt to new challenges. A solid investment plan is the foundation of success. Define your goals, choose your strategy, and set clear rules for buying and selling. Regularly review your portfolio and make adjustments as needed. Whether you favor value, growth, or a combination, a well-thought-out plan will keep you focused and disciplined. If you're unsure which investing style is right for you, consider seeking advice from a financial professional. Advisors can help you assess your goals, risk tolerance, and time horizon, and recommend a strategy that fits your needs. Professional guidance can provide peace of mind and help you avoid common pitfalls. Sum up, value and growth investing are two distinct but complementary approaches to building wealth in the stock market. Value investing focuses on finding bargains and steady returns, while growth investing seeks out companies with high potential for expansion. Both strategies have their strengths and risks, and the best choice depends on your personal goals and preferences. Ultimately, the choice between value and growth investing comes down to your individual circumstances and what you hope to achieve. By understanding the differences, learning from the experts, and staying disciplined, you can build a portfolio that reflects your unique vision for the future. Remember, successful investing is about making informed decisions and staying committed to your plan.